Now, what does remembering a number for 5 seconds have to do with running a business and these weird-looking psychological questions? How could something this weird actually work and get those results? It turns out this is not actually that weird. It's been used to solve a very similar problem rather successfully. And this problem is the problem of pre-employment screening. So big companies, when they have to fill a job, they have a lot of people coming to apply. They need to filter through these candidates in a low-cost, automated way. They have very little information available about those candidates. And you know that the candidate is going to try to, let's say, make themselves seem as positive as possible, if not outright lie and try to beat and game your test. And these organizations have solved this problem with these exact kind of tools. That's where we've drawn these tools in from. These tools are used to select employees applying for jobs, including by many banks. And a recent study by the American Psychological Association shows that these type of tools outperform personal interviews, background checks, and any other type of personnel selection in human resource fields. So they're working very well there. In addition to that source, there's been studies about entrepreneurs and entrepreneurial ability and what makes up a successful entrepreneur. That's been happening for the last 30 years, and that also uses these tools. A lot of people who work in business, they are basically already sophisticated entrepreneurial detectives. They can talk to an entrepreneur in about 5 minutes. They can tell if this person has what it takes or not. And what they're doing is measuring a lot of these traits that we can measure with these tests. We came up with this idea at the Center for Investigation for International Development at the University of Harvard about 5 years ago, and we began a study to see whether or not this idea can work. We got some funding from Google.org, and we went out and we tried this test across Africa and Latin America, and we got surprisingly strong results. Testing existing clients, you can see that these types of tests can separate the wheat from the chaff, can separate good risks from bad risks. Based on those research results, as Francisco mentioned, we were very quickly approached by Standard Bank, which is the largest bank in Africa, which, like many other large international banks in emerging markets, they were focused on corporates, they were focused on salaried individuals, areas where there was a lot more information and it was easier to evaluate risk. But they saw also the big opportunity in SMEs and wanted to get in there. So they said, let's try this out. In Kenya, starting in 2010, every single person wanting an SME loan, when they come in the door, they would go through the bank's own evaluation, and then they would go through our evaluation. And if one or the other said yes, they'd make the loan. So in cases where we say yes, but they say no, they would still make the loan. And in cases where we say no and they say yes, they would also make the loan. So there we can see very clearly how much does this test help in splitting risk in segments the bank's already active in, and also how well does this test work in opening up completely new segments. This is pretty risky, lending against this tool that was developed by these people at this university, not even in Africa, but they wanted to try it out. And that's been happening now for about 1.5 years, and we have quite a few results from there. What you can see is, first of all, in cases where our evaluation and their evaluation agree, that had the lowest arrears rate, 2.8% at 30 days or more. Their evaluation is kind of a typical evaluation, checking credit history, looking at turnover and bank statements, and then making a decision based on that. But cases where we say no and they said yes, they still made the loan, and what you find is that a much higher percentage entered into arrears in that basket. So already we can see that in segments that the bank already lends to, this type of tool as an additional source of information on top of bank history, on top of collateral and financial statements from other banks. This type of tool can add quite a bit of risk splitting power. And then the most interesting, especially from a development perspective, is this third box. Now, don't let the 9.7 number scare you. Basically, this institution, at prevailing interest rates in this market segment, they said accept everyone up to a 10% chance of arrears at 90 days, in that case, because those are still profitable clients. And what we found is that we're basically getting their exact target arrears rate. Now, again, we spit out a score, so you can choose any risk cutoff you want. Turn the tap on, turn it off. They want it up to 10%, and that's exactly what we're hitting. And the most interesting part is that number below the percentage. That's the number of loans up until this point in time. So 3/4 of the loans made under this pilot program were cases where we said yes and they said no. Most of the cases where they say no, it's not because this entrepreneur is coming in, they have a detailed credit history, they have a detailed borrowing history, and you know this person's not good, they're running their business poorly. It's not a definite no, it was a case of we don't know. You can't provide enough documentation to prove your creditworthiness, so we will reject it. People that fell into that bucket and we said yes to made up 3/4, and it's turning out to be extremely profitable for the bank to expand into the SME segment. Single pilot in Kenya, and then the bank very quickly decided to expand it to 3 other countries, to South Africa, which is a much richer country in Africa, as well as Ghana and Nigeria, also in 2010. And then we've just signed an agreement with them to expand it to 9 additional countries across their African footprint. They're currently lending about $1 million per week out against this tool, and they split this they've stopped this 2x2 evaluation system, and right now they're only doing a pre-filter plus this test. And their ROI on this, on this loan product is about 10 times their average, and they've gone from a 0% participation in the SME sector in these African markets to now over 20%. So it's been hugely successful for them. And we also have data from Latin America, where we started on the research phase. This shows some results from a bank in Colombia. We're basically looking only at approved clients. How much additional risk splitting power can the test have on those approved clients in Colombia, formal SMEs? If you just split it up into the top third and the bottom third, the top third on this EFL psychometric evaluation had a 72% lower arrears rate than the average for existing clients, and the bottom third had a 94% higher than average arrears rate. So even on top of existing information, the risk splitting power is surprisingly strong. Currently, we've tested now over 13,000 entrepreneurs, and the number's growing rapidly across 18 countries and 11 different languages. In the process of spreading this tool out to quite a few emerging markets in the world. And this tool was selected as one of the winners in the recent G20 SME Finance Challenge, which was an online open competition to find new solutions to unlock SME finance in a profitable, scalable way to allow banks to really take advantage of this opportunity that we talked about at the beginning. The IFC and the Inter-American Development Bank were in the process of expanding that. So part of that project that Francisco mentioned is that FOMIN is providing assistance to help spread the use of this tool in Latin America by supporting 4 banks to do a large-scale implementation using this type of tool. And this we're just launching. BBVA Bancomer in Mexico has already jumped in and taken the first spot. So FOMIN will be supporting implementations of at least 3 other banks to try out this tool across the region. So the basic summary is that by bringing in new sorts of information, this can allow financial institutions to profitably attack this very large opportunity in the formal SME segment. And in existing segments, this type of tool can also help both reduce costs, because it can split risk on top of additional existing information, and also reduce costs, because you move from a high transaction cost, human-intensive process to rely more on low-cost automated technology. And that's it. We're happy to take any questions you might have, and also happy to discuss any interest in potentially trying this out in Latin America. Thank you.